Everybody loves higher risk, higher return, and that has been the mantra in the market. So how do you see yourself advising them here?
I also think people make a mistake. After the event, people change their asset allocation. So like after equities have gone down, they'll sell equities, and after gold has gone up, they'll invest in gold. Good return on capital over the long term for wealth creation. The first rule number 1, do not lose money. Rule number 2, never forget rule number 1.
India has been fastest growing economy in terms of GDP per se. If you see the last few years, it has been one of the worst performing markets globally.
I'm referring to the fact that Indian markets tend to have overvaluation without having any compensatory effect on the downside. So not only because of the Iran war, because of the fact that you have such global fragility, you need to have some money which is away from your long only product. People say, मुझे market जब top में लगता है मैं SIP में पैसा लगा दूंगा और जब bottom में लगता है मैं long only में लगा दूंगा. People can't see an Iran war. People will not know when the Iran war stops.
Hello everyone, I am Rushabh Shah, founder of Midas Finance. Today I welcome you to our first episode of Paisa and Perspective. Over the past few years, investors had to navigate through difficult geopolitical tensions, increasing volatility in commodity prices, and ever-changing market conditions. To help us decode this, today we have distinguished market personality, Mr. Rajesh Bhatia, who is Chief Investment Officer at ITI Mutual Funds. So Mr. Rajesh Bhatia comes with 3 decades of golden experience into equity markets, managing portfolios, and he comes with vast experience of 18 years in managing long and short equity strategies, which makes him the most experienced fund manager in the industry. So Mr. Rajesh, as we all know, the most common question that investors are going through today is with respect to the current geopolitical tensions and war that is going on. What is your experience about how is it going to impact the Indian markets and how far it can go from here?
Yeah, so it's already actually impacting equity markets. I think for the month as we sit today, the Nifty is already down about 11 odd percent. Mid caps and small caps even more.
Yep.
So it's already impacting the equity markets. The reason why there is an impact is because high oil prices impact the macroeconomics of the country, right? And large equity market corrections happen when macros of India get dislocated. So this is one of those moments when, because of high and rising oil prices, and in fact not only rising prices but lack of availability of gas and oil, there is a potential for the macroeconomics of India to get dislocated, which is causing, and which has historically caused, and it's also causing a correction in the equity markets. What I mean by that is, see, India imports 80% of our crude requirements. And therefore, when crude prices go up, right, from $70 to $100 or $120, it means that our import bill rises, right? So our current account deficit widens. The pressure of that is felt in the rupee. And as you import that at higher prices, the pressure either will be felt by the government fiscal deficit, the oil marketing companies, or the retail public, because fuel prices are passed on. In any of these cases, inflation will get impacted. So if inflation gets impacted, your borrowing costs goes up, interest rates go up. So that also brings a slowdown in the growth of the economy. There are many other factors, but this is a simplistic explanation that basically high oil prices will mean rising inflation, rising interest rates, depreciation in the currency, and therefore a slowdown in growth. And that is impacting the markets. So like I pointed out, what is important to note is rising oil prices dislocate macros, and historically, large equity market corrections have happened whenever there has been macro dislocations. This is one of those moments. So that is what we are going through.
As you rightly said, oil prices are currently a major worry, and it is the macro worry that is dislocating the Indian markets. How are you seeing the oil price trending from here? Because currently crude oil has already breached $110 per barrel. And how much does it impact further to the Indian economy? which are the major sectors which are dependent on oil, which are getting impacted in a big way? So if you can bring some light on this matter.
So basically, roughly, we import about 130 to 150 billion dollars of oil. Some part of that is also exported, but just for the sake of simplicity, we import a lot of oil, 80% of our oil, and if like I pointed out, if that bill goes up, so if we were, let's say, averaging about 60 or 70 dollars per barrel, if that goes to 120, that's like doubling of our import bill, right? And that causes major worry. From a sectoral perspective, it will mean that companies like, let us say, ONGC, which actually produce oil, will benefit from that. There are some companies which are into refining, right? Let us say like Reliance, right? So unless a windfall tax is imposed, they benefit from rising refining margins. Because there is going to be an energy shortage, there will be companies like Coal India, which could benefit because coal prices could go up because there will be greater substitution towards coal. So basically, energy generating companies are more likely to benefit. But there are going to be companies which are going to be impacted. Now, as I pointed out, it's a macro dislocation. What does that mean? Growth slows down, interest rates goes up. That starts impacting, let us say, sectors like NBFCs. That derates the equity market per se. So the P's as interest rates go up, P's come down. So price earnings ratio of the market is dependent on interest rates. If interest rates rise, P's come down. And if interest rates decline, P's go up. So in this case, I'm suggesting that interest rates could go up. That's the fear of the market because people don't know how long this Iran war could last. So if it gets over in the next 1 week, hurrah, we are again back to equity markets being sanguine and positive as you move forward. But what if it lasts 2 weeks, 3 weeks, or 4 weeks? That's a major dislocation of the energy markets, and that can cause all of these challenges, and therefore is depressing not only sectors but the entire market because the P of the market itself is declining.
So the next question is one of my major questions that I wanted to ask you today is, India has been one of the fastest growing economy in terms of GDP per se. But if you see the last few years, it has been one of the worst performing markets globally. How do you see this, and how can we dissect this in terms of today's market where the global macros are still pushing it down further? And how do you see value here, and what is your overall viewpoint here?
So I think you're trying to correlate high growth rates with equity valuations which are not doing well.
Yes.
Okay, so let's just step back a little. See, what happened during the COVID period was, when the COVID crisis happened, the governments stepped up spending, right? So the government fiscal deficit increased. When governments increased spending, the economy bounced back. From the low of 2020 till September 2024, equity markets in India did fabulously well, right? So we had a fantastic run in that period. But remember, that was also caused by the government expenditure which had stepped up. That government expenditure which had gone from the fiscal deficit of 4% to 7%, right, had to be brought down. Very sensibly so, because when you have a high fiscal deficit, it means you're borrowing. You needed to control your debt to GDP as well. And if you do not control your debt, it creates an imbalance. So what the government of India rightly did was reduce their fiscal deficit, which means they reduced their spending. Again, what did I tell you? The government expenditure was the reason why markets went up. Now, if the government slowed down the spending, it meant the momentum of the economy also slowed down, right? And therefore, while valuations peaked in September 2024, because people were looking at the back as to what the government did, the markets then looked forward, which is that the government expenditure is slowing down and that will slow down the earnings growth rate. So since September 24, we had a slowdown in growth, right? And which caused the equity markets to also kind of go sideways. I don't think we had a major correction until this Iran crisis. But now there is another challenge, which I spoke about, which is that the Iran crisis has meant oil has gone up. So we have become even cheaper. So the correction is more painful because now the market is addressing this challenge. So while the incremental reduction in fiscal deficit is not very high, it is the Iran problem that we are dealing with. So we had a great 2020 to 2024, After that, there was a slowdown. We were actually very well poised until January of this year to kind of start moving up again because earnings had started to move, right? But for this crisis, which has again suppressed valuations, so that's really where we are.
How do you see the current opportunity when it comes to different market segments like large cap, mid cap, and small cap? And where do you see the best risk is to reward ratio?
So I think large caps have certainly become cheap, right? I would say that they've become fairly valued. I mean, of course, it depends upon how the Iran crisis kind of pans out and what it leads to globally as well. See, I've always maintained that the global situation is extremely fragile. You know, just to step back, the last 25 years, the developed world has used their fiscal and monetary policy very, very aggressively. And that has meant the equity markets have been buoyant all throughout. But they've used all that firepower, right? And because you have used so much of your monetary and fiscal policy, which is spending a lot, throwing a lot of money at problems, that you've hidden a lot of problems and you've created bad incentives for actors in the financial markets. So I think they have created a bit of fragility in the global financial space. This macroeconomic crisis is actually, I hope it doesn't open up this can of worms. So we don't know what are the challenges that can come, as you move forward as well. So that's another challenge as we kind of contend with this.
So looking at 3 to 5 years from now, and keeping in mind that, as you mentioned, large cap is an area where you will be looking at yet. So which are the sectors which you think are structurally placed in a way where they have a strong tailwinds?
So just to complete that thought process, large cap is really where the fair value is. Mid caps and small caps in India have been, they are also higher growth areas, but they are also higher PE areas.
Okay.
Right? And I think at some level, people can see the duration of growth in mid caps and small caps because they are smaller as well. They are going to grow faster for a long period of time, and therefore people are also willing to pay a higher price earnings for these businesses. But they tend to be more volatile as well. So when a risk-off environment like this takes place, they also fall a lot more, and vice versa, right? So mid caps, large caps is really, on an absolute basis, it's relatively cheap. I don't think you can call mid caps and small cap as cheap on an absolute basis, but on a relative basis, they have certainly become a lot cheaper.
And with this understanding, if I have to go for a particular sector with a 3 to 5 year perspective, where do you think the major strong tailwinds are?
So if interest rates go up, I think private banks will certainly do well, right? Because they are going to reprice their asset side of the book far more quickly. There are sectors like telecom, which will again be a very good defensive to my mind, right? There are going to be areas like insurance, which are very steady state, right? Now, it depends upon how the war pans out. If it is short, lot of these sectors, I would say capital goods, right? Transmission and distribution investments, all the investments that can happen in data centers, which will power stocks, capital goods stocks, etc. Defense. I wouldn't say that defense is cheap right now, but again, it has great visibility of growth. But a lot of this, the latter sectors that I mentioned, is to some extent dependent on whether the war gets over quickly or later. But the earlier sectors that I mentioned, telecommunication, private banks, insurance, etc., are becoming cheap on an absolute basis itself. And regardless of the war pans out, these are now cheaper at, or fairly valued at least on an absolute basis itself.
So, as many interactions that we are having with the clients, the investors are currently confused whether they need to go sector specific versus they need to focus on asset allocation in current situation. Because as we all know, everybody loves higher risk, higher return, and that has been the mantra in the market. So how do you see yourself advising them here?
See, for any normal retail investor or even a HNI, I would say that asset allocation is one of the most important components of their managing their investments, right? So I also think people make a mistake. What again I keep observing. After the event, people change their asset allocation. So like after equities have gone down, they'll sell equities, and after gold has gone up, they'll invest in gold. These are fundamental errors that they keep making again and again, right? After the equity markets go down, they'll think of defending the portfolio. So a lot of the asset allocation is one of the most important components of you compounding wealth. And there is a need, if there is one area that investors and advisors need to concentrate on, is asset allocation, and that has to take place before the event. As far as stock picking or sector allocation is concerned, see, if you're an individual investor who manages the portfolio himself or herself, and if you're a stock picker, concentrated stock picker, then it doesn't matter which market environment that you are in. But if you're a retail investor or a HNI investor, asset allocation takes primacy.
As you rightly said, you have experience of around 18 years into managing long and short equity strategies. What is your viewpoint? How has that strategy played in the current market scenario?
So, I think consistently, the long short equity strategy that we have managed, every time that the market has dipped, we've been able to protect downside. Please note, I'm saying downside, not capital. So every time, and this time is no different, we are again managing downside well, not as much as capital, right? So I think to answer your question directly, the good thing about a long short equity strategy is that it protects your capital or on the way down or downside on your way down, and it also participates on the equity markets when it goes up, right? So that's really what it does, and we've been doing that for a long time, and that's what we are doing in the current environment as well. I think your second part of your question is, how does it do in sideways markets? There's very little to distinguish. I'll be honest with you. It's in a sideways market, it's not as if the market is 2% plus or minus and I can make 20%. That just doesn't happen. Because we're still in equity market and we are still large cap to mid cap oriented funds because we need liquidity. So we are still oriented our portfolio towards large cap and mid cap. So we are still linked to the market because we hold a diversified holding, etc. So in a sideways market, there's nothing much to take away. When does the value add of a long short be felt? It's felt when you have a trend. Either a trend on the downside, then you are protecting downside, or on the upside, where you are participating on the upside. In the interim, when the markets are sideways, there's very little to distinguish a long short equity from a long only product.
So as we all know, there's a lot of buzz going on around SIF. So if in a layman's perspective, explain to an investor who is looking at SIF for the first time, how will you say it? What is SIF for that person?
So basically SIF is an umbrella, right? Just like mutual fund is an umbrella. SIF is not a product. I still think that there are people who compare different SIFs, saying that this SIF has done X percentage and this SIF has done Y percentage. It's like comparing a liquid fund with a small cap fund. Do you ever do that? No. So you can't compare one SIF with another. SIF is like an umbrella, like a mutual fund. In that mutual fund umbrella, you have equity funds, right? Large cap fund, mid cap fund, flexi cap fund. Then you have fixed income funds, ultra short term, right? Overnight funds, etc., etc. And then you have hybrid funds, right? Balanced advantage fund, equity saving funds, etc. So nobody compares a small cap fund either with a liquid fund, right? So similarly in SIF is like an umbrella which has equity funds, equity long short. It has fixed income funds and it has hybrid funds. The objective of the hybrid funds usually that we have seen so far, and most of them are really in the hybrid fund, all the SIFs that have been introduced, their objective is income generation. Most of them want to give you arbitrage plus returns, right? Whereas the equity long short category, they want to give you an asymmetric return profile. What is that? Basically, they are equity products, but they want to participate on the upside of the equity markets, but don't participate as much on the downside of the equity markets. So you cannot compare an equity long short product with a hybrid product. You need to understand what the mandate and what the objective and the strategy of the SIF is. But SIF is a product which is, I think, even more given what is happening. So I've always believed that, you require a macro dislocation for people to recognize that a lot of their portfolio is in only long only, right? So by the way, the hedge fund market globally is $5 trillion. The equity long short strategy is $1.5 trillion. There are people who recognize the value addition of a long short equity fund management. In India, typically, we have been an excessively long only market. Everybody does just long only, right? People don't have an allocation to guard against declines. So I have always maintained that when a macro dislocation takes place, that is the time that people will realize, oh my God, my asset allocation was all to long only products. What is that product that I have that can defend my portfolio? Because remember, capital protection is a necessary condition to compounding wealth over the long term. If you want a good return on capital over the long term for wealth creation, the first rule number one, do not lose money. Rule number two, never forget rule number one. One of the fund managers said that, and a lot of people don't remember this rule. That is the trick to compounding wealth. So if you need to compound wealth, first learn how to protect your downside. And a long short equity fund just does that.
So with that, we know what a long short equity fund does. What kind of an investor should look at SIF? And if today he has to invest into SIF, how much of his portfolio should he consider investing into SIF? What should be the portfolio allocation?
So the minimum investment that is required in SIF is 10 lakh rupees, right? So clearly it's meant for somebody who can have part of his allocation in SIF. I'm not saying you should take all your money from equity funds and invest in an SIF. Equity funds have their own raison d'etre or the reason for existence. Having said that, anybody who qualifies with that threshold should actually have an allocation to the long short equity fund, even more so given the current environment. I'm not even only referring to the Iran challenge. I'm referring to the fragility that is there in the global markets. I'm referring to the fact that Indian markets tend to have overvaluation without having any compensatory effect on the downside. So because there is always money that is flowing into the equity markets tends to get inflated in terms of valuation. Where is your balancing factor? SIF long short equity fund is your balancing factor. So not only because of the Iran war, but also because of the fact that you have such global fragility, such global volatility, policy making which is uncertain, monetary policy which is stretched, fiscal policy which cannot expand anymore, right? Fragility in the financial space that has been created over a long period of years. You've been hearing of the $2 trillion of private credit market, which is fragile at this moment. Private equity, where an excessive amount of money has gone, and there may be challenges there as well of leverage. So there is just so much global fragility that is there, geopolitics, geoeconomics. You need to have some money which is away from your long-only product. So I would recommend that of your equity portfolio, 20% of that should be in a long-short equity product as well.
As you mentioned, all the risk that a portfolio is carrying today, what are the key risk management principles that an investor should keep in mind when they're looking at SIF as an investment?
So basically, look, I think fortunately the risk management is done by the SIF fund manager itself. I would argue,
okay,
if the SIF fund manager says, I will protect your downside of equity and I will give you an equity return, that should be separated from the asset allocation call itself. Which means I mentioned that asset allocation is important. You don't need to dynamically asset allocate in an SIF. Nobody predicts Iran war. Yeah. So all these things happen very, very suddenly. I have heard people say, when मुझे market जब top में लगता है मैं SIF में पैसा लगा दूंगा और जब bottom में लगता है मैं long only में लगा दूंगा. ऐसा नहीं होता है. Right? People can't see an Iran war. People will not know when the Iran war stops. So you need to have a durable allocation to an SIF and just remove it from that asset allocation call. If I give you downside protection and make you an equity return, that alone should be enough, and you leave the worrying to the fund manager itself.
And as you rightly said, SIF is a product that you cannot time in. It is something that you have to leave in the hands of fund managers because they are doing their job of riding the markets and riding the volatility. With this comes a very important role for Divinity SIF strategy. How do you see it evolving in the market especially with the current situation in sight?
I think people recognize it even more. I mean, people who are invested in Divinity SIF and in their equity portfolio will recognize that this is going down dramatically, and while this is somewhat protecting my downside, they'll see the value add. It's only when the markets go down the drain that people recognize the value add of a long short equity fund. Thank God I had money in a long short equity fund, right? So even more so, people are observing, and fortunately a lot of people are observing Divinity SIF at this moment. They will recognize I need to have an allocation to an SIF long short equity fund. And we've been in the business for long. We have an 8-year track record in ITI itself in the long short equity space. Probably one of the more consistent track records and one of the longest track records in the equity fund management space. So I think people will move a lot more of their assets to Divinity SIF as you move forward. I would call it product of the year. I would call it product for the next 5 years.
That's a big statement.
Yes?
Yes. And that brings us to the most important question. And that is, with 3 decades of experience that you're having, what is that one piece of advice that you'll give to an investor who is coming into the market with a view of 10 to 15 years?
So if you're coming to 10, 15 years, look, let me tell you, my 30 years experience is equity is a very good asset class to be in, right? But equity is also a very volatile asset class, and you have to keep watching it for excessively valued conditions, right? Equity is not for all seasons, right? But investing in businesses, because what are you doing? Owning a business gives you the best wealth.
Yes.
What are you doing when you're investing in an equity fund? Right? You're basically owning a variety of businesses, some of the best businesses in India. And how will those businesses do in 10 years or 15 years or 20 years? They'll do extremely well. Right? Because we are confident of, as you pointed out, India is one of the fastest growing economies in the world. So it'll come back. Right? So equity investing is one of the best ways to generate wealth, no question. SIPs has been a very, very good way to kind of invest over a period of time. The only grouse I have with Indian equity investors is they feel, one, that equities don't have risk. That I think needs to be altered. That I think you need to modify that view. And second, valuations don't matter, right? I think that that's something that people need to kind of fine tune. Valuations do matter. Third, macroeconomics risks are not important. I don't know where these thought processes get ingrained. I think, again, that is a incorrect understanding of equity. Macroeconomic, as we are finding out, do matter. And fourth, lastly, when most importantly, keep expectations of returns on equity modest, right? Because I speak to people, then they say, 25% chal jayega. 25% chal jayega. So their return expectation is just crazy from equity markets. So I would think those are broadly some of the things I would point out to Indian investors, and you'll have a happy journey.
Well, that's amazing. So to summarize today's conversation, thank you for highlighting the 4 most important points that an Indian investor is currently missing. The first one being equity risk, second one being valuation, at which the investor is investing today in the Indian markets. The third being macroeconomic risk that they are avoiding and not looking or keeping into perspective when they are investing into markets. And the fourth and the most important one is to have modest return expectation. These 4, I believe, are going to be the most important golden rules that you have shared today as pearls of wisdom. It was a pleasure having you on the show. Thank you everyone for tuning into Paisa and Perspective. I hope this conversation made you think differently about markets and investments.